So going on to a little bit of the first three projects. The first project we financed was 460 Collins Street. I'm not sure if some of you know that, down on the corner of Collins and William Street. It's a $400,000 project. A lot of it was end-of-life kind of activity as well. Installation of a high-efficiency chiller unit and building management system, and aims to cut a nominal amount of greenhouse gas emissions. There's also controls that go into that one here. We'll just quickly go through a couple of the other ones. Again, these building owners had to do these works. They undertook the process in which we've set up and worked through with them to get this project, and it was fully funded through this program. Second project was 123 Queen Street, funded by the NAB through their product. It's a $1.3 million project, and something appeared in the paper about this project the other day, looking at tri-generation occupancy sensors and building envelope actions as well. There's a higher amount of greenhouse gas savings associated with this because of the fuel switching, and significant project because it's the first time that private finance actually globally has been mobilised through a mechanism like this to this kind of project. The last but not least is King's Technology Park, which is down in 100 Dorcas Street at the very edges of the city of Melbourne. It's a $3.5 million project, looking at the traditional kind of projects, high efficiency chillers, cooling towers, air conditioning units and controls. Again, that's a precinct of 5 commercial office buildings on one block. This was an upgrade of 4 of those buildings in there. And these applicants went through that process to use an EUA to fund part of that project. Okay, so I've put up on the screen here a diagram, which I apologise to the people down the back. If you flick to the back of your notes, there is actually a copy of that you can see and read. We had feedback from the last sessions that we learnt from, and we've now attached those for your convenience. I'm going to go through really the first box here, which is project development. I'm going to spend quite a lot of time on this space and then open up to questions after that, and we'll go and have a tea break following that, and then Bronwyn will come in and talk about the rest of the 7 boxes following that. But basically, this is an overview of the whole process, from development through to implementation, and we're going to keep referring back to this as we move through this slide pack. So first of all, before you come to us and apply, you've got to develop a project. We've gone out of our way to help you understand what we'll be looking for to approve projects. So we've put up on the Sustainable Melbourne Fund's website a list of common and custom improvements list, and also the process of going through all of that. You've been given a guide in your pack there, which is the application guide, as well as some of the application forms. All of that information will be available from us, but also up on the website. We recognise that one of the key roles of the consultant is to assist your clients in developing retrofit projects. This is where I'll really go into some detail to try and illustrate some of the commercial opportunities that I hope you see for your clients as we work through it. So first of all, what is the prerequisites for a project? Well, the City of Melbourne is very interested in getting greenhouse savings as well as water savings benefits out here. So we, through working with the City, have identified that basically the first step to be part of the 1200 Billion program is undertake a level 2 audit. Identify a comprehensive list of opportunities that you could do within your building. Some of them may not be feasible or sensible economically or logistically for whatever reason, but undertake an Australian standard level 2 audit. An equivalent for water might be WaterMap, but a similar process where you can identify what businesses would be using if they did nothing, if they did A, B and C, this is where they would be at, and what are some of the relevant costs to all of that. A retrofit action plan, which may be part of the audit, which is basically this is the list, this is what we're going to do, this is the total cost, and this is the total benefits as associated with all of that. And basically between yourselves and your customers, you obviously got to understand, put the scope around that project, and that might come through the audit report. Where an action plan involves tenant contributions, prepare a business case for tenant engagement. One of the tools that the Sustainable Melbourne Fund is working on, just as an aside, to help all of this, is working on behalf of the City of Melbourne and Low Carbon Australia to develop what we're calling a tenant engagement tool. This will be a free online cash flow model that businesses and building owners like yourselves can use to input your project findings and develop up some cash flow models from a tenant's perspective as well as from building owners' perspective. So we really hope that that comes through. Once you've done all of this, you've done your level 2 audit, you've done your action plan, you've made a commitment to join the 1,200 buildings, you sign a letter to the Lord Mayor to join up to the 1,200 buildings, and then we can move through the process. But individually, how you each develop your own project will differ. Broadly speaking, we've looked at essentially 4 main areas of project development. Starting on the very left here, we have an energy efficiency driver. For some reason, you've ended up before a CEO or CFO or facilities manager, customer saying, I want to do something about this, hopefully. The second stage is they've said, righto, go along, tell me what I can do. We've called this the pre-feasibility stage. We've considered this really from a building owner's point of view. So pre-feasibility is actually the audit. If you're an ESCO or an energy services company, you're probably doing a detailed facility study. How you deliver the works that you do, you basically scope out opportunities for buildings in the pre-feasibility stage and present often a cash flow analysis associated with that. And then the major stage where a lot of these projects have in the past fallen over is in the feasibility stage. Feasibility basically means that the building owner takes your report, looks at their business plan for the next 12 months, 2 years, and says, what's on my agenda? What do I want to be doing? Is this something I should be doing? And they make assessments. They'll look at their balance sheet, their profit and loss statements, cash flow implications, debt obligations, all of these things that as a consultant, you're pretty well unaware of prior to sitting and trying to work through this stage. Often this is a bit of a hazy stage for you as a contractor, and hopefully you get a positive result popping out the other side into project delivery and the project gets off the ground. So those 4 major areas from a building owner's perspective is really the areas in which it comes into. And I'm going to focus a little bit on the feasibility stage because there's some important implications that really need to come into this. And I insert my disclaimer here, but we're just going to touch on how this may be considered by a building owner when they examine the opportunities of financing a retrofit project through environmental upgrade finance. So they're going to turn around and they're going to say, all right, well, what are the accounting benefits? How do I treat this on my balance sheet? Well, if we take the conservative approach, and preliminary indications are that, and global trends are that, from international accounting standards, that these assets would be recognised as an asset on the balance sheet. So if we take that as a starting position, you'd have these assets and future liabilities put onto the balance sheets. There'd be implications through to profit and loss statements. So the interest component associated with the annual charge would be an expenditure item on the profit and loss statement. Any receivables you have from the tenants associated with this would also be treated as an income. Now, obviously, when you open up new revenue streams to buildings, there's every likelihood, and this will depend entirely on your project and your customer, but where you open up new revenue streams, there's a highly likelihood, so long as revenue exceeds costs, that you're going to increase profitability. And there also may be cash flow implications associated with this from a building owner's perspective. As we all know, financing a project, one project in one building, look at the building very next door, they'll have very different financial performances. Some of them will be paying very different energy rates. Some of them will have different opportunities. They'll not be the same, and so this is project by project, and each building owner will need to consider the implications of working through this. And then the last question that commercial office buildings really come down to is property valuation. So there's a lot of market-based information out there of the IPD Sustainability Index, as well as the Building Better Returns, that basically point to better performing buildings delivering better valuations in property. The opportunity and the question that we still have out there is, by opening up a new revenue stream, by working with your tenants to undertake comprehensive building projects, by opening up that new revenue, do you materially improve the value of your asset? When you fund these kind of projects outside of an EUA using traditional debt, you don't have the opportunity of opening up this new revenue. However, with the environmental upgrade agreements, you do have that opportunity, and that has a material impact to the way in which the economics work of these kind of projects. So that really comes down to the point here that tenants are the key to this opportunity. They're the ones that are sitting on the low-hanging fruit. They're the ones that are exposed to future energy price rises. They're the ones that are going to be suffering from those risks into the future. So building owners working with tenants are the ones that we can deliver win-win solutions. The other key point there, of course, is once you get through that assessment, that your customer essentially makes that feasibility assessment, then you agree, let's go forward, go into financial close. And if you, as a service provider, do a turnkey solution, you would assist in project managing or indeed implementing the projects.